Bringing you the latest in tax credit news, this is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the May 30, 2023 podcast. We frequently talk on this podcast about affordable housing. And when we use the term affordable housing, we're generally referring to apartments rented to low-income tenants at restricted rent levels. These properties are nearly universally funded with equity from the low-income housing tax credit and/or through funding from the Department of Housing and Urban Development. That said, there's another type of affordable housing, and that's for sale housing that's affordable to low to moderate income owners. This type of housing is often located in economically distressed communities and nearly universally also requires some non-traditional funding sources. In today's podcast, we're going to discuss for sale housing in distressed communities. And we're going to look at various funding sources with the central focus of today's Tax Credit Tuesday being the use of new markets tax credit equity to close financing gaps. Now, for some listeners, the use of new market tax credits to finance for sale housing might be a bit of a surprise. Traditionally, new markets tax credit equity is used to fund investments in or loans to operating businesses, commercial real estate, and construction in qualified census tracts. Furthermore, residential rental real estate is generally an ineligible business. Now, I say generally because there is a key exception, and many of our listeners know that would be for mixed use rental developments. That said, new markets tax credits can finance the construction or renovation of for sale homes, and that's what the purpose of today's podcast is. Now, if you do plan on using new market tax credit financing for residential real estate, there are additional non-tax code related limitations that are put in place by the CDFI fund, with the CDFI fund being the allocator of the new market tax credit allocation issuance authority. One such requirement is that at least 20% of the total housing units that are financed by new market tax credits must be maintained as affordable housing units. And that comes with some specific definitions, which broadly mean that the properties are affordable to households with income equal to or less than 80% of the area median income. Furthermore, those households should pay no more than 30% of their income for the housing. Now, my guest today is George Barlow, partner in Novogradac's Dover, Ohio office. George is active in the new markets tax credit space, as well as working with clients in the historic tax credit, renewable energy tax credit, and opportunity zones arenas. George has helped clients use the new market tax credit to help finance for sale housing for most of his career. So he's an expert in this area and will share his experiences and insights in developing for sale housing in distressed areas. Now, in today's podcast, we'll begin by looking at various sources of financing for sale housing. Then we'll look at the requirements for doing so with new market tax credits, followed by a discussion of who does this type of financing and areas in the country where it works best. After that, we'll look at when a developer should begin working with a community development entity, and that is the entity that controls the new market tax credits. And then we'll wrap up with some specific issues that developers should consider if they're working in this area. There's a lot to talk about. So if you're ready, let's get started. George, welcome back to Tax Credit Tuesday. It's been about a year and a half since you were last a guest. It's good to have you back.
Thank you, Mike. It's great to be here.
So in this podcast, the financing source we're going to spend the most time on is using equity from new markets tax credits to finance for sale housing. And we'll get to more of those details in a bit. But new market tax credit, as I mentioned in the intro, is just one of several sources of financing that make up the financial stack when you're financing for sale housing. So I was wondering if you could explain some of the other sources or list some of the other sources of financing for sale housing, as well as explain some of the challenges in using these other types of financing with new markets tax credits.
Sure. The financial stack can include equity, loans, charitable donations, state and local grants, state new markets tax credits, and donated labor. Transactions can be financed with any of these sources without federal new markets tax credits, but it becomes more difficult. The federal new markets tax credits provides a subsidy to the project to help offset the increased construction costs that the industry has been experiencing over the last few years. Some challenges combining these financing sources with the new markets tax credit include collateral issues, donated labor not being an expenditure for the business, and supporting prior expenditures, which can be used as leverage for the new markets tax credit transaction.
So as I mentioned in the intro, many don't usually think of the new market tax credit as a tool to finance for sale housing. So I was wondering if you could provide a high level overview to our listeners as to how new market tax credits can be used to support for sale housing. And also maybe discuss some of the restrictions developers face when they use new market tax credit financing.
The developer or a portion of a business of the developer will receive a qualified low income community investment or CLICI, uh, which they will use the loan proceeds to pay for construction costs to build the houses. The Qualig B then sells the home to a low to moderate income family at typically at a reduced price. Some developers provide a discount and rely on the families to obtain third party financing for their mortgage, where other typically nonprofit developers will provide a first and second mortgage, where the second mortgage can be forgiven at a later date under certain stipulations. Some of these conditions could be that they donate some of their time and labor to build other houses, that they stay current on their payments and stay in the home. In order to qualify, the Quality B must satisfy tangible property, employee services, gross income, collectibles, and non-qualified financial property tests for the compliance period. Additionally, they must meet this active standard. And to do this, they have to build and sell at least one house for the 7-year compliance period. Many projects use the portion of a business rules to satisfy these tests, as there can be times where the developer would hold too much cash, or they might have tangible assets that are outside of a low income census tract.
Right. Thank you for that. And when I think about the new market tax credit financing for sale housing, you mentioned QLICs. And for the less informed listeners, that's qualified low income community investment. And that's the loan or investment that the CDE makes in the qualifying business. And the qualifying business ends up being the developer. So the developer themselves are the qualifying business. And that's where you get into the QLICB rules, qualified active loan community business rules that George was mentioning, in terms of the developer being the qualified active loan community business, with ultimately the homeowner buying the homes from the developer. And there's various ways in which the new market tax credit subsidy finds its way to the end user homeowner. And we can maybe talk about that more in a bit if we have time. But I thought it'd be useful. We talk about qualified active low income community business. We talk about qualified low income community investment, QLICI and QLICB. They both have low income community in their title, which is a bit of a foreshadowing as to the geographic restrictions that apply when you're using new market tax credits to finance for sale housing. So maybe you could elaborate on this low income community requirement or general requirement.
Sure. So to qualify, the houses that, the tangible property, which is going to be a house in this case, must be located in a census tract that has at least 20% poverty or has a median family income that does not exceed 80% of the statewide median family income. Now, to further expand upon it, in order to obtain allocation, many CDEs check the box and they're looking for severely distressed census tracts. And so to give yourself the best chance of attaining allocation, you might want to go and to the level of severely distressed census tracts. And they usually get preference from community development entities. In order to qualify as a severely distressed census tract, you have to have poverty rates greater than 30%. Your median family income for the census tract cannot exceed 60% of the statewide median family income, or you can have unemployment rate that's 1.5 times the national average.
So I think what you're discussing here is that there's the federal rule as to eligible areas that technically become low-income communities for purposes of the QLICI and QLICB definitions. but as part of the competition process, the CDFI fund encourages commitments to deeper distress. And as a practical matter, if you're a developer out there, you need to be in one of the deeper distress communities to get a CD interested in using their allocation for your development. Would you agree with that?
Yes, exactly. Thank you for further expanding upon my explanation.
Now, I hinted at generally you have to be in this type of geographic area. But there's probably a listener saying, well, Mike, why did you say generally? Or they might be thinking that they have a for sale development that's not located in a distressed area, as you just described. And you and I both know that all is not lost. There is a more nuanced option if you're not geographically located in a distressed community. So if you could explain that alternative at a high level to our listeners.
Yes, they can potentially qualify under the targeted population rules. In order to qualify, at least 50% of your homes that you're selling must be to low income individuals. And those houses must be located in census tracts that do not exceed 120% of the statewide median income. There are additional compliance requirements when you're doing target populations, but I know in the past we've had specific podcasts on targeted populations, and I would suggest that listeners go back to that podcast.
You know, we did do a podcast on targeted populations with our partner, Brian Hung, not that many months ago. So I'll include a link to that podcast in today's show notes. But as always, if you just said target populations, Brian, Novogradac, Tax Credit Tuesday, I suspect Google will bring it up. So I mentioned earlier that using new markets tax credits for sale housing is not that common, at least not that common yet. So maybe it'd be useful if we share with our listeners who some of your typical clients are here.
So I mostly work with nonprofit developers. Um, I've successfully closed many transactions with Habitat for Humanity affiliates. I've closed several with for-profit developers. They typically have a philanthropic interest as well as part of the transaction. Smith NMTC Associates is a consultant and a client of mine that has obtained allocation, closed, and provides compliance services to many for sale housing transactions. They have lots of experience, and they, in my opinion, provide excellent service, which result in a quick, efficient new markets tax credit closing.
Yeah, I'm glad that you mentioned Smith NMTC Associates, and we'll discuss more about our upcoming conference, but I do expect that they'll be at our upcoming conference in Washington, D.C. In June. So if you're interested in meeting with them in person, that might be a great venue for you. But getting back to the purpose of the podcast and not talking about the conference, if I'm thinking of, if I'm a developer listening to this podcast or know of a developer listening to the podcast, and I'm trying to decide if my development might be appropriate for this type of financing, or at least a portion of my development. One of the questions that would come to my mind is, well, how many homes are typically involved in a single new market tax credit financing? So maybe you could describe that.
So in my experience, it's typically between 10 and 50 homes that each developer uses in a transaction. The main threshold is you need to be able to use your clicky proceeds within 12 to 18 months from the closing. It is common for several developers to combine together into one closing of new markets tax credits. It helps gain economies of scale and minimize the transaction costs. I have done a few projects here or there where, they using condos and larger buildings that will reduce that number. But the most common is the single family housing and 10 to 50 unit, houses.
So we discussed earlier how, generally speaking, unless you're using target populations, the development has to be within a low-income community, which is a geographic designation. But beyond those specificities, I suspect there are other attributes to a geography that make for sale housing, new market tax credit transactions more attractive to developers, community development entities, and investors. So maybe you could discuss some of the broader geographic indicators that might make this type of financing more achievable.
I believe it can work anywhere, but it seems to be most successful in locations with housing shortages and available land. Um, Popular projects are located in some of the underserved states referenced in the new markets tax credit application.
Just to unpack your reference to underserved states a bit, the CDFI fund ends up identifying certain states that are underserved in the sense that they haven't gotten as much new market tax credit allocation proportionately as other states. As a consequence, CDEs that are going to agree to serve those states will be looking for developments in those states and investments in those states. So it gives you a leg up if you have a development in one of those states, because you're going to be that much more attractive to the CDEs. And the one thing about using new market tax credit financing or seeking new market tax credit financing for sale housing, as with any community development project, you have to first come up with a project that's financially feasible, but for the new market tax credits. And then you also have to find a CDE that's willing to use their new market tax credit allocation for your development. And we all know that new market tax credits are way oversubscribed. We need to get increases in the allocation available, but until we do, there'll be this ongoing competition. So you'll need to be as attractive as possible to attract a CDE. Which brings me to my next question. If I am a for sale housing developer, or I have a development or know of one, and I'm thinking of using new market tax credit equity in my capital stack, they just heard me say how you have to attract a CDE to want to finance your development. So or not so much what, but when should developers be reaching out to CDEs to try to seek new market tax credit financing? Because there's always this gap between, the CDEs want to use the financing. Once they get an award, they want to get the money out as quickly as possible. These types of developments take time. CDs make commitments during the application phase. Maybe you just describe the process that a developer should be thinking about if they want to use new market tax credit financing and have an approach to CDE yet.
I would suggest they get started as early as possible. You should connect with CDEs that have service area in your location. Uh, Talk with them about the benefits and your um, projects in the pipeline, so that you can potentially get listed in their application and listed in their pipeline of transactions. So if they do get a new markets tax credit allocation, that they can provide it to your project.
Yeah, it's, as they say, never too early. It's never too early to start. And I would just echo that in terms of getting to the CDE early in the process. And once you get to the pipeline, that means you're going to be a year plus away from when they could actually finance your development. So it is very early in the pipeline. And if you are wondering which CDEs to reach out to, feel free to reach out to George, and he can help give you some names of CDEs that might be interested in your developments. So now the next question runs the risk of getting really, really wonky. And I love wonk. I love tax wonky. But let's not get too wonky here. But I do think we should touch upon some of the major tax issues that are involved when new market tax credits are used to finance for sale housing. So if you could just describe, 3 or 4 of some of the major issues, and once again, without getting too wonky, but because I'm sure some listeners who are already familiar with new market tax credits might have some questions on that front.
Sure. The first I would say is the leverage structure, just knowing what um, sources you have for leverage and having differentiation between a leverage lender and your project so it will be respected. The second one, specific to for sale housing, is a lot of times there's volunteer labor and dealing with how to measure those costs and whether they can be included or not. And then the third one, and kind of deal more with on the compliance side, is I mentioned earlier in the podcast, but the non-qualified financial property can, trip up a transaction, and thinking about having enough expenditures within 18 months to use your cookie proceeds so that it does not trigger this non-qualified financial property test.
Thank you for that. And what portion of the businesses that you work with on for sale housing, would you say, just roughly percentage wise, would you say the developer is providing some degree of carryback financing to the buyer?
I would say 75% or so.
So it's a high percentage
Yes.
carryback financing. And I won't reveal all the ins and outs here, but many listeners may be looking at that and saying, are those loans non-qualified financial property? And you and I know they're not. If you want to know more details on how that works, give George a call. So this is an interesting topic. Thanks for joining me on the podcast to talk about for sale housing financing, particularly with respect to new market tax credit financing. We obviously just skimmed the surface today. To our listeners, I will provide George's email address in today's show notes. If you have any questions, you can email me at cpas@novogradac.com. George, before I wrap up, is there anything else you wanted listeners to know?
Yes. I work on and close several of these every year. And if anybody's interested in doing one or has a potential transaction, I happily would provide the financial forecast that's needed to close a transaction. I traditionally do compliance AUPs, whether it's targeted POP or standard quality B requirement AUPs. I do tax returns for some of the leverage lender entities that are involved in the for sale housing new markets tax credit transactions. And also, I wanted to remind everybody of our New Markets Tax Credit Conference in Washington, D.C., June 8th and 9th. I will be there and would be glad to talk with you if you are thinking about or have a for sale housing transaction.
Great. Thank you. And thanks for mentioning the New Market Tax Credit Conference. It'll be a lot of great information to share. And it's always a great opportunity to network. And it's particularly useful to the new market tax credit community to get introduced to more CDs and fellow developers, investors, leverage lenders, and the like. Switching topics for a moment to our listeners, please be sure to tune into next week's podcast. Peter Lawrence, who's Novogradac's Director of Public Policy and Government Relations, will join me to talk about the Affordable Housing Credit Improvement Act of 2023. That legislation was recently introduced, and Peter will be here to talk about the loan closing tax credit provisions contained within the legislation. He'll also talk about, and this might be more important to many listeners, what are the chances that portions of the bill will be included in other tax legislation this year. If you're involved in affordable housing, this is a chance to get a better understanding of what's happening in Washington, D.C. with the loan closing tax credit and where we're headed this year. Plus, if you have any questions you suggest we cover in that episode, please email me at cpas@novogradac.com. So George, now I'm pleased to have reached our off mic section where I get to ask you for some fun off topic recommendations or get you to share some words of wisdom. One question that I enjoy asking my guests, because I always learn from them, is what is the best leadership lesson you've learned?
That would be know when to delegate tasks. This is something I still struggle with getting correct all the time, but I keep trying to improve each year. Um, sometimes it's difficult to delegate everything, but for the most part, you should be able to delegate a lot of your tasks, and you have a limited amount of time, and you have to leverage with your employees as much as possible.
Thank you for that, George. That's one of my challenges as well, is to delegate more. Most things can be delegated. And sometimes I think I can't delegate something when, if I'm prodded, I'll realize I can delegate it, which is also, a bit of a lesson. Kind of the inverse of that is to go to others, particularly if there's like a reporting structure, like if you have a manager or a principal, senior staff, for them to go to you and ask for the task. So if you could train your team to encourage you to delegate, it can help you delegate some of the tasks that maybe you're not aware that you could be delegating because you haven't identified it yet. So you've been practicing as a CPA long enough to have a pretty interesting perspective on a career as a CPA. What would you say is the most important thing that you know now that you didn't know at the start of your career?
I would say building rapport is important. And whether that be coworkers, clients, potential clients, I used to always think people would prefer just to get to the point, get down to business. I always assumed that everybody was busy and just want to get to the point. But I've read some research and papers saying that's not the case. That the developing a rapport, getting to know people, that you're more successful and you just have improved outcomes once you build rapport.
No, that's a great idea. Plus, there's so many things that you can analyze and solve and optimize when you're having a dialogue back and forth that you don't necessarily get when you're in your lab by yourself. So it's not a surprise that the research that you've seen shows that building rapport can lead to better outcomes. So thank you, George. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.